Hello everyone, today I'm going over the second part of the extra problems of chapter 6. First problem number 20. You are planning to save for retirement over the next 15 years. To do this, you will invest $1,100 a month in a stock account and $500 a month in a bond account. The return on the first account is 7% and it's 4% on the second account. When you retire, you will combine your money into an account with a 5% return. How much money can you withdraw monthly during retirement, assuming a 20-year withdrawal period? So this problem can mainly be divided into two parts. The first part is the savings part, and the second part is the spending part. So here, over the first 15 years, we are investing our money in two separate accounts. This is the first account, the stock account, and this is here the bond account. We are earning here 7% as our APR, and for the second account, our annual return is 4%. So what I need here to do first is to determine how much money I will have at the end of the investment period in the stock account and how much money I will have here in the bond account. So let's start with the first account. For the first account, I have $1,100. This is the payment. 7 divided by 12 equals, this is the monthly interest rate. 15 times 12, 180. This is N. And then I compute FV. Now, the future value of the first account is $348,658.53. Now I move to the second account. For the second account, I'm investing $500 a month. This is my payment. The interest is 4 divided by 12, 0.33. This is IY. N is the same. 15 times 12 equals 180. This is N. And then I compute FV. The future value is $123,045.24. So now after 15 years, I will have in the first account this sum of money, $348,000. In the second account, I will have this sum of money. Now I will add the two accounts together. And invest at an APR of 5% compounded monthly over the 20 years period. And over the 20-year period, I'm gonna withdraw a certain amount of money on a monthly basis till I reach the end of year 20. Now I need to determine the amount of each and every payment. So now I have the following. I have I have PV, the amount that's invested here now. This is mainly the sum of FVS plus FVB. So the future value accumulated in the first account plus the future value accumulated in the bond account. I added those two together, and now they will represent my present value. So the present value is $471,703.77. I enter this value into my financial calculator as PV. 5 divided by 12, this is IY. Then I have 20 times 12 equals 240, this is N. And finally, I compute the payment PMT. In this case, the payment is 3,113.04. So mainly in this problem, I have invested in two separate accounts. The first account is stock account yielding 7% annually. The second account is a bond account yielding 4% annually. After 15 years, whatever money accumulated in the first account, I added that to the amount accumulated in the second amount for a sum of 471,703.77. Now, that amount of money was invested at 5% compounded annually, and then each and every month for a period of 20 years, I was able to withdraw an amount of $3,113. So that's it for this retirement problem. Now I move to problems that relates to the annuity due. Now, in order to determine that this is an annuity due, you need to determine when the first payment is happening. If the first payment is at the beginning of the period, this means I have an annuity due. So if the payment is at the beginning of the month, at the beginning of the quarter, at the beginning of the year, this means that I'm dealing with an annuity due. In case the payments were at the end of the period instead of the beginning, this is the ordinary annuity or the end annuity. Now, problem number 21, you buy an annuity that will pay you $24,000 a year for 25 years. The payments are paid on the first day of each year. This means this is an annuity due. What's the value of this annuity today if the discount rate is 8.5%? So mainly here I have, this is the payment. Here I have 25, this is N, and 8.5, this is IY. But now before I can use my financial calculator and solve, I need to change the mode of the calculator to the begin mode. Now, in order to do that, I have to follow the following steps. First, you click on second, begin, which is mainly the payment button. Then you click on second, set, which is mainly the enter button. Then you click on second, quit, which is mainly the compute button. So this is how I can go from the end mode to the begin mode. Now, once I do that, you should see on the screen of your financial calculator, here you should see begin. If you want to go back to the end mode, to the ordinary mode, you follow exactly the same steps. And now when you click on second quit, the begin mode will disappear. Nothing will appear here. So you won't see, let's say, end. You should not see anything once you're in the end mode. So now to solve this problem, after I do the steps, after I'm in the begin mode, I enter 24,000 as the payment. 25N, 8.5 IY, then I compute PV. Because here I'm asked about the value of this annuity today. This means that I need to find the present value. The present value in this case is $266,498. Now for the second problem, you are scheduled to receive annual payments of $5,100. This is the payment for each of the next 7 years. So those are annual payments over a 7 years period. The discount rate is 10%. What is the difference in the present value if you receive these payments at the beginning of each year rather than at the end of each year? So in this case, I need to solve once in the begin mode and the other time in the end mode. And mainly I will have exactly the same entries. So mainly I'll have the following: 5,100, this is the payment, 7 is N, 10 is IY, I compute PV, excuse me, not FV. So compute the present value. The present value in this case is 27,312. Now, if I'm in the end mode, I still have exactly those same entries. And mainly when you go back from the begin mode to the end mode, I do not even have to make those entries because those values are already stored in my financial calculator. So I click directly on compute PV. This time, however, I will get a different answer because now my financial calculator is in the end mode. The answer now should be 24,829. The difference between receiving those payments at the beginning of the year rather than at the end of the year is 27,312 minus 24,829, and the answer is 2,483. Now, number 23, Trish receives 450 on the first of each month. So this is a begin annuity or an annuity due. Josh receives 450 on the last day of each month. So here I have the ordinary or the end annuity. Both Trish and Josh will receive payments for next 4 years at 9.5% discount rate compounded monthly, because here I have monthly payments. What is the difference in the PV of these two sets of payments? So once again, I have the begin mode and the end mode. While I'm in the begin mode, I should make the following entries. 450, this is PMT. The interest is 9.5% compounded monthly because I have monthly payments. I have N is 4 times 12, so 48 is N, and I compute PV. In this case, PV is 18,000, 53.58. Now I switch back from the begin mode to the end mode by clicking on second begin, second set, second quit. Once I'm in the end mode, those entries are already stored in my financial calculator. So I click on compute PV. This time the answer is 17,911.78. So the difference between those two amounts is equal to 141.8. Now problem number 24. Teresa adds $1,500 to her savings account on the first day of each year. So this is begin. Marcus adds $1,500 to his savings account on the last day of each year. This is the end mode. They earn 6.5%. What is the difference in their savings account balances at the end of 35 years? So this time I need to find the difference between the future values between the begin annuity and the end annuity. So while I'm in the begin mode, I have 1,500. This is the payment. 6.5 divided by 12. This is IY. I have 35 years. 35 times 12, 420. This is N. Then I compute FV. The future value in this case is 198,145. For the end mode, I still have the same entries. I compute FV, and here the answer is $186,052. So the difference between those two amounts is $12,093. Now, to go quickly over the reasons behind this difference. So with the begin mode, this is, let's say, 0, here 1, 2, till 420. Here I have the periods and months. So with the begin, the first payment is made at t equals 0. The last payment is made here at the beginning of the month number 420. This means at the end of the month number 419. So this is when I'm making the last payment. When I'm in the end mode, I'm making the payments at the end of the month. So my first payment is at t equals 1. The second payment is at t equals 2. So now here I have my last payment at month 420. So if you look at the difference between the two, all the cash flows, they're exactly the same, except for that first payment here and that last payment here. So with the begin mode, instead of making a payment at month 420, I'm making that payment now at month 0, or at time t equals 0. So mainly that difference here, that 12,093, is mainly the future value of that amount invested in month 1. Now that's it for the problem that relates to the annuity due. And the important thing is that make sure that you go back to the end mode whenever you finish any question that relates to the annuity due. Now questions that relates to growing annuity. Now with growing annuity, I'm going to use the following formula. PV equals C divided by R minus the growth rate into 1 minus 1 plus the growth rate divided by 1 plus R to the power T. So now you have just one the lottery and you will receive $540,000 as your first payment 1 year from now. So this is payment number 1. $540,000. You will receive payments for 26 years. N equals 26. The payments will increase in value by 4% each year. Now that growth rate is G, which is 4%. The appropriate discount rate R is 10%. What is the present value of your winnings? So this is clearly a growing annuity because that payment is growing year after year. The first payment is $540,000. The second payment is equal to $540,000 times 1 plus the growth rate, so times 1.04. The third payment, this is $540,000 times 1.04 to the power 2. So the annual amount I'm receiving is increasing year after year by the growth rate of 4%. In this case, PV is equal to the following: C, which is the first payment, $540,000 divided by the discount rate R minus the growth rate G. So this is 0.1 minus 0.04 times 1 minus 1 plus the growth rate, so 1.04 divided by 1 plus R, so 1.1. This is raised to the power T, which is in this case 26 years. The answer in this case is equal to 6,906,372. Now for the second problem on growing annuity, number 26, you just settled an insurance claim. The settlement calls for increasing payments over a 10-year period. This is T or N. The first payment will be paid 1 year from now in the amount of $10,000. So this is the first payment, or C. The following payments will increase by 4.5%. This is G, the growth rate. What's the value of this settlement to you today if you can earn 8% on your investments? This is R. So now PV equals C, 10,000, divided by R minus the growth rate, so 0.08 minus 0.045 into 1 minus 1.045, 1 plus the growth rate, divided by 1 plus R, 1.08, raised to the power T, so this is raised to the power 10. And the answer in this case is 80,192.76. So that's it for the growing annuity. Now for perpetuity. A preferred stock pays an annual dividend of 3.2. What is one share of this stock worth today if the rate of return is 11.75%? So mainly this preferred stock is gonna pay you this annual dividend of 3.2 each and every year till infinity. In this case, the present value is equal to C divided by R. So this is 3.2 divided by 0.1175. And the answer here is $27.23. Now, number 28. Wicker Imports established a trust fund that provides $90,000 in scholarships each year for needy students. The trust fund earns a fixed 6% rate of return. How much money did the firm contribute to the fund, assuming that only the interest income is distributed? So, in this case, Wicker Imports, they donated a certain amount of money at time t equals 0, and this amount of money was invested at 6% rate of return in a way that each year this fund pays the same amount of $90,000 each year till infinity. So in this case, starting from the formula PV equals C divided by R, PV equals 90,000 divided by 6%, 0.06, and the answer is $1.5 million. Number 29. A wealthy benefactor just donated some money to the local college. This gift was established to provide scholarships for worthy students. The first scholarships will be granted 1 year from now for a total of $35,000. So this is the first payment C. Annually thereafter, the scholarship amount will be increased by 5.5%. This means this is the growing rate or the growth rate. To help offset the effects of inflation, the scholarship fund will last till infinity. What's the value of the gift today if the discount rate is 9%? So this is the case of a growing perpetuity, where the present value is equal to C divided by R minus the growth rate. C, which is the first payment, is $35,000 divided by R, which is in this case 9%, minus 0.055. So the answer in this case is $1 million. Finally, number 30. You just paid $750,000 for an annuity that will pay $42,000 a year forever. So this is a fixed payment that will last forever. So this is the case of a perpetuity. But now in this case, I have the present value and I have C. I need to determine R. In this case, R equals C divided by PV. So this is equal to $42,000 divided by $750,000. And in this case, the answer is 5.6%. So if you can earn a 5.6% forever, you can invest this $750,000. In this way, you can receive an annual cash flow that will last forever of $42,000. Now, question number 31, APR versus EAR. Your credit card company charges you 1.65% interest per month. So this is the monthly interest rate, 1.65%. What is the annual percentage rate on your account? In this case, I can use the following formula. APR equals the periodic rate, which is 1.65, times the number of periods in a year. In this case, the number of months in a year, which is 12, and the answer is 19.8%. Number 32, what is the APR on a loan with a stated rate of 2.75% per quarter? So this is the quarterly interest rate. So APR equals 2.75 times the number of quarters in a year times 4, and the answer is 11%. Number 33, you are paying an effective annual rate. So here I have EAR equals 18.974%. The interest is compounded monthly. So M equals 12. What's the annual percentage rate on this account? So here I need to find APR. In this case, I need to apply the formula that we've learned in chapter 6, which is the APR as a function of the EAR. So in this case, APR equals M into 1 plus EAR to the power 1 over M minus 1. In this case, APR equals 12 into 1 plus EAR, so 1.18974. This is raised to the power 1 divided by 12 minus 1. The answer in this case is 17.5%. Problem number 34. What is the effective annual rate? So here I need to find EAR. If a bank charges you 8.25% compounded quarterly. So here APR is equal to 8.25 compounded quarterly. This means M equals 4. So here I need to apply the formula of EAR as a function of APR. So EAR equals 1 plus APR divided by M raised to the power M minus 1. So this is 1 plus 0.0825 divided by 4 raised to the power 4 minus 1. And the answer in this case is 8.51%. So mainly, as you did see the questions about APR and DAR, you will be directly asked to compute either EAR or APR. The second time you will have to compute EAR, the second type of problems where EAR is to be computed, is when you need to compare between two different alternatives, or mainly more than one alternative. So in this case, if you have different investment opportunities, in order to choose between those different investment opportunities, you need to compute the effective annual rate of each alternative. The same will apply if you are considering different loans. So if you are considering different loans, you want to choose the loan with the lowest effective annual rate. So here you want to choose between two credit card offers. So with the credit card, you are paying interest. So it's a loan. So you need, in this case, to choose the credit card that has the lowest effective annual rate. Now, the first credit card, the American Express, quotes a rate of 17.9% compounded monthly. So EAR of A, of the first offer, is equal to 1 plus 0.179 divided by M divided by 12 raised to the power 12 minus 1. The first EAR is equal to 19.44%. The second, Discover, its EAR is equal to 1 plus 0.178 divided by 365, because it's compounded daily, raised to the power 365 minus 1. And the answer in this case is 19.47%. So although American Express charges a higher annual percentage rate, it's better for you to choose the American Express credit card because it has the lowest effective annual rate. Now, number 36. The pawn shop loans money at an annual rate of 23% and compounds interest weekly. What is the actual rate being charged on these loans? On this case, you need to find the effective annual rate of those loans, which is equal to 1 plus 0.23 divided by the number of weeks in a year, which is 52, raised to the power 52 minus 1. And in this case, the answer is 25.8%. Number 37. Here you need to choose between two alternative investments. When you are choosing between alternative investments, you should choose the one with the highest EAR. So I compute the EAR for each investment. Of the first investment, this is equal to 1 plus 0.225 compounded semi-annually, so divided by 2 raised to the power 2 minus 1. So this is equal to 23.77%. For the second investment, this is equal to 1 plus 0.215 divided by 12, because I have monthly compounding, raised to the power 12 minus 1, and the answer is 23.75%. In this case, because those are investments, I need to choose the investment with the highest EAR, so I will choose investment A. Of course, this should be investment B. So A is the better investment. Now, number 38. What is the future value of $1,200 a year for 4 years at 8% interest, assuming annual compounding? So here, this question asks you about the future value of an annuity, because this $1,200 is to be received each year. If the question was, what's the future value of $1,200 after 4 years? In this case, the $1,200 would have been the present value. However, here the question is the future value of $1,200 a year. So this $1,200 here is not a PV, it's a payment PMT. For years, this is N because I have annual compounding, and 8 is IY. I compute FV in this case, and the future value is equal to 310,868. Now for number 39, what is the present value of $1,200 to be received after 20 years? So this $1,200 here, this is FV. Here T, this is the number of years. If the discount rate is 8%. However, in part A, I have annual compounding. So for part A, I solve in the following way. I have 1,200, this is FV. I have 20 is N, 8 is IY, and I compute PV. The present value with annual compounding is 257.46. In part B, I have semi-annual compounding. So I will have 1,200 FV, it's still the same. Now N is 20 times 2, because with semi-annual compounding, M is equal to 2. This is 40N. 8 divided by 2, 4. This is IY. I compute PV, and the answer is 249.95. I do the same thing with part C. In part C, M is equal to 4 because I have quarterly compounding. In part C, I should get a PV equal to 246.13. In part D, I have monthly compounding, so M is equal to 12. PV in this case is equal to 243.75. And finally, with daily compounding, assuming 360 days per year, so M is 360. PV in this case with daily compounding is 242.32. So now, as we did see, when the frequency increases, when M increases, PV will decrease. However, when M increases, the future value FV will increase. Now for the last part, I have amortized loans. So for number 40, you are borrowing money today at 8.48% compounded annually. So 8.48%, this is IY. You will repay the principal plus all the interest in one lump sum of $12,800. So mainly, here you are taking a loan and you are paying this loan back 2 years from today. The amount that you are paying is $12,800. The interest rate is 8.48. We need to determine how much you are borrowing. So we need to determine the present value PV. In this case, 2 is N, 12,800. This is FV, and we compute PV, and the present value in this case is 10,877.04. Now problem number 41. This morning you borrowed $9,500. So this is the amount of the loan. $9,500, this is PV, at 8.9% annual interest. So 8.9, this is IY. You are to repay the loan principal plus all of the loan interest in one lump sum 4 years from today. So in N is equal to 4, how much you will have to repay. So I need to find the future value of the loan. So compute FV, and the answer in this case is 13,360.88. Now, number 42, on this date last year, you borrowed $3,500. So this is last year, you took $3,400. You have to repay the loan principal plus all of the interest 6 years from today. So here the trick is to determine that N is 7 and not 6 years. Because you took the loan last year, you took the loan in year -1, and you need to repay the loan 6 years from today. So between year -1 and year 6, I have 7 years. So here I need to repay the loan. The payment that is required at this time is $6,000. What is the interest rate on this loan? In this case, those two cash flows, they're going in opposite directions. At year T equals -1, you are receiving $3,400, so this is a cash inflow. So the $3,400, this is PV. The $6,000, you are paying that amount of money, so it should have a negative sign. This is FV. 7N, you compute the interest rate on the loan IY. IY in this case is 8.45%. Now for the final question. Question number 43. This morning you borrowed $150,000 to buy a house. This is PV. The mortgage rate is 7.35%. The loan is to be repaid in monthly payments over 20 years. So mainly I need to use the monthly interest rate. The monthly rate in this case is 7.35% divided by 12. I need to pay back the loan over 240 payments, which is N. The first payment is due 1 month from today. So how much of the second payment applies to the principal balance? So in this case, as a first step, I need to determine the payment. So here I have the following. 150,000, this is PV. 7.35 divided by 12, this is IY. 240 is N. I compute the payment. Now I will go to Excel to solve this problem. So here I have the loan is 150,000. The interest rate is equal to 7.35% divided by 12, because here I need the monthly interest rate. Of course, here because of rounding, it shows 1%. So let me add more decimals. So here, the monthly interest rate is 0.6125%. The number of years is 20. So now I need to determine the monthly payment. Now when you compute the payment is 1,194.6692. Of course, this is after rounding. So now let me start with this table. Here I have the month. So mainly here I will have 240 months. And then I need to determine the beginning balance. Now, mainly my beginning balance is $150,000. So this is equal to this amount, the amount of the loan. The total payment is fixed and is equal to the monthly payment. So for this cell, I'm gonna use F4. And here you can see the dollar sign before E and after E. So this cell now is fixed. The interest paid is equal to the beginning balance times the interest rate. And here, once again, I need to click on F4, enter. The principal paid is equal to the total payment minus the interest paid. The ending balance is equal to the beginning balance minus the principal paid. Now for the second month, the beginning balance is equal to the ending balance in month 1. And now mainly I can drag this formula till I get till month 240. Now, of course, here the 2 cents, this is due to rounding. So you can see the schedule of payments over this 240 months period. And as you can see from this schedule, the balance, of course, will start at $150,000. It will decrease till 0. The total payment is fixed. The interest paid is decreasing month after month because the beginning balance is decreasing. However, the principal paid is increasing because always the interest paid plus the principal paid, they are equal to the total payment. So now let's say that you take this loan and let's say you want to pay back, let's say you get some bonus from your work and you want to settle your balance, let's say, after 5 years. So after 60 months. So let's go to the payment number 60. So once you make the payment number 60, your outstanding balance is $130,066.16. So you can go to your bank and tell them, I need to pay back all the loan. So in this case, it's not like you need to make all the rest of the payments of the fixed payments of 1194.67 times 180. The amount that you should pay in this case is exactly 130,066.16. Now, if I go back to the given of the problem, the question was to determine the amount that I should, like, how much of the second payment applies to the principal balance. So the answer is mainly 277.61. So this is the answer.